Hello investors, my name is Dehan. Welcome back to number one place for all your investing needs. So in today's video, we're going to be talking about the potential three stocks to be buying right now as the market has been dipping for the past month or so. And we're kind of in a bearish situation. And we saw a little bit of a recovery on Friday. Could that be, a rebound, or was that a dead cat bounce right there that we saw happening in the market? And, could stocks just continue to plummet into next week? It's a very high possibility. But as the stocks continue to go down, we're always going to be looking for opportunities to buy the dip and load up, dollar cost average. That is your best friend in my opinion, especially if the stock falls behind, below your buy price. So if you bought a stock for $1,000 and now it's at $800, it is usually good to dollar cost average, buy some for $800. That way your $1,000 average continues to go down lower and lower, and you can get in, at a lower level. That means in the future, when the stock comes back up, you need it to come to a, lower level compared to that $1,000 level, and you can actually make some profits as it continues to rise on higher. So guys, let's get into it. But before we get into this content, smash that like button for me. Let's aim for 50 plus likes on this video. Subscribe to the channel, turn on that bell notification so you get notified every time I make a new video. And as always, leave a comment below letting me know which stocks are you buying right now. So let's get into it. The first stock, it has been beaten down very hard. It's going to be Netflix, guys. So if we take a look here at the 1 year chart on Netflix, it's a decent stock, right? It was trading here around $500 to $600 in this channel. $500 was kind of like the support level right there. Kept bouncing back and forth between 5 and 550. Even broke here through 600 in September. Continued to rise on higher. Created a little bit of a support level. Continued to push on higher here. Past the $600 range. And even here up to highs of about almost $700 at one point as we continue to push on higher and higher, which is very nice here. Obviously, the highest we reached right here was around November 17th, right at around $700.99. So after November, pretty much around Thanksgiving time, we went from $700. Now we're trading at around $387 actually, as this stock continues to push on lower and lower here. So we were trading here end of December at around 600. We saw earnings happen here at the beginning of January, and we went even lower here from about $500 to all the way down here to lows of under 300 and something dollars at one point. So we've been going down and down and down in the past few months, but that is because of earnings. So obviously, Netflix shares falls 20% on slowing subscriber growth. So we obviously all saw that during the earnings season. So the company said for the first quarter of 2022, it expected to add 2.5 million subscribers compared to the 3.98 million it added in Q1 of 2021. So what happened here? What happened here with the market, and what happened with the stock? So earnings per share, the EPS was $1.33 versus 82 cents. Expected in a Refinitiv survey of analysts. The revenue was at 7.71 billion versus the 7.71 billion expected. So pretty much they, pretty much matched what they were expecting. So global paid net subscriptions, 8.28 million versus 8.19 million expected. They beat on that as well right there. So they added many new subscribers, but the bad thing was, they actually lowered their guidance for the next quarter, I guess you could say. So they are expecting to add 2.5 million subscribers during the first quarter of 2022, far below the almost 4 million it added in Q1 of 2021. Meanwhile, the analysts had expected 6.93 million in the first quarter. So that is more than half less than what they were expecting. And that is the reason why Netflix obviously started to pull back lower and lower, and we were down about 20% or so because of the guidance right there. They had predicted lower growth. As you can see here, Netflix subscriber growth. So quarterly paid net subscribers added, as you guys can see here, every single quarter. Here in 2020 and then 2021 here, obviously the fourth quarter, 8.3 million, which was a great number, obviously. Obviously, we have high numbers here in 2022, but that is because of the pandemic. More people were at home, more people were getting, watching Netflix and doing other things like that. So Netflix said increased competition from other companies was one of the reasons for the slowdown, obviously. So though it in the past had said companies like Apple and Disney wouldn't matter, to affect the growth, it actually did. So as Apple and Disney, obviously Disney Plus continues to grow higher and higher, there's competition, and competition is not good for Netflix right now because people are transitioning. People are going to find which product is the best and which one is the best for them. So one thing to look at Netflix though is EPS. It's at around 11.12. We have a forward PE of about 34.55 right now, and the market cap is very lower compared to where we were, a few months ago. We're at 171.68 billion market cap right now. Now, when we were trading at $700 or so, we were close to about almost, let's say, around a 300 billion market cap or so. So Netflix has taken a huge beating here in the past 3 months. Huge beat of almost $285. As you guys can see, lower from the high right there as it continues to plummet basically. So could Netflix be an opportunity to buy the dip right here? I personally think so. As you guys can see, volume is actually increasing here in the past few days. So we saw 58 million shares traded there. We saw 32 million. And as you guys can see, compared to where they were before, it is a lot higher after earnings. So definitely an opportunity, in my opinion, to look at Netflix, see if it fits your criteria, and potentially buy the dip on Netflix. It is definitely a stock that I believe could come back in the future, as it still has amazing growth. A company that added almost 3 million subscribers, that is amazing in my opinion. It's still growing and it continues to grow. People are just expecting way too much, I believe. They're still making revenue, and I just believe that it's a great company overall for the long term. So you guys let me know in the comments below. Do you agree or disagree with my opinion? So that's going to be the first stock. The second stock on our list is going to be Apple. So AAPL right here. If we take a look here at the 1 year chart, Apple is definitely looking beautiful. It continues to push on higher and higher here. We saw highs of about 182, 183 or so up here towards December. And then obviously a pullback down here with the market in the past few months. So it went from that 180, 183 area all the way down here to lows of about 160, 157 right before earnings, as it continues to pull back down, as you guys saw right there at 157. And then after the earnings, boom, we popped up to about $170 right now, as you guys can see on the 1 day chart. Apple just destroyed it here, and pretty much it actually potentially saved the stock market, in my opinion. And a lot of people are actually agreeing with this and saying the same thing, because Apple said that the supply shortage is not as bad as it was, and it's getting better, and this caused Apple to go up about $11 on Friday, closing out very green and helping the rest of the market push on higher. But as we see, it's been growing here. It was trading at around 120 or so in the beginning of 2021, continued to grow, push higher here to 160, bounce down to 140 at a support. So previous resistance levels become new supports, bounced off of that 140 and hit highs of 180 at one point, with the pullback to 160, which was a previous resistance area right here that became a new support level once again. So that's exactly what's happening with Apple. Now with Apple, obviously revenue pops 11% to 123.9 billion. 123.9 billion, guys, in one quarter. That is insane. Some companies don't see that in years or even ever. So wow, this is what Apple did, guys. We have a lot of numbers here to read for you guys. So EPS 210 versus 189 estimated, up 25% year over year. Destroy those earnings. Revenue 123.9 billion versus 118.66 billion estimated, up over 11% year over year. Destroyed that as well. iPhone revenue 71.63 billion versus the 68.34 billion estimated, which is up 9% year over year. Destroyed that part as well. So we it's just getting insane. Services revenue 19.52 billion versus 18.61 billion, up 24% year over year. Destroyed that one as well. Other products revenues 14.7 billion versus 14.59 billion, which is up 13% year over year. Destroyed that one by a little bit, but still a beat. Mac revenue 10.85 billion versus 9.52 billion, up 25% year over year. Destroyed that one by a mile again. Then we have iPad revenue. This is where they did not beat. So 7.25 billion versus 8.18 billion estimated, down about 14% year over year. So a little bit of a down, on that one, but everything else destroyed it, and it didn't really affect things as much. So gross margin is at 43.8% versus the 41.7 million, or 41.7% estimated. He said right here, so Apple CEO Tim Cook did provide a forward-looking data point in an interview with CNBC. So what we expect for March quarter is a solid year-over-year revenue growth. That's what he said. And we expect supply constraints in March quarter to be less than they were in the December quarter. This was the exact sentence right there that pretty much potentially saved the market and could possibly, start a rally here going into next week. So he is saying that the supply constraints are kind of getting better, which is a positive thing, because we saw other companies like Elon Musk's Tesla. He said that those constraints were getting, still bad, and that is the reason why Tesla is not going to be, doing some crazy things, starting a $25,000 car and different things like that. And Tesla actually tanked about 10%, I believe, after earnings the day after. So if we take a look here at Apple, the way it's performing and everything, Apple EPS at around 6.09, PE, forward PE is going to be 27.96. These are just numbers that I'm seeing, so they could be a little bit different. They actually have a dividend yield, so if you're a holder of Apple, you actually get paid a dividend of 0.52%, and that is around 88 cents per share, give or take a few cents depending on the price of the shares. Market cap right now is at 2.6 trillion, so the market cap continues to grow and higher. One of the highest, market caps out there that we're seeing. Apple continues to grow. It is probably one of the safest companies to be invested in my opinion, right now. And it's just pretty much guiding the market. Whichever way Apple goes, that's pretty much the way the market is going to go. Definitely one of the more safer tech companies to be invested in my opinion. So that's going to be the second stock. And then last but not least, number 3, it's going to be MSFT, Microsoft. So you guys already know this one here. Microsoft, in the past 3 months, we saw highs at one point at over $343, obviously right there. And then we pulled back down here to lows of under about, what would I say here? Around $280. So $280 from those highs. That's a pretty nice chunk, about $60, $65 lower than it was. So we see Microsoft last year at the beginning of the year was trading at around 240, hit highs here at around about, let's just say 260, pulled back down to that 240 support. So previous resistance areas become new supports, broke through that resistance area of 260, continued to move on higher, made a little channel here around 280, pushed even higher past the 300 range, pulled back down to the 280 support that we see previously here in July, and then broke through that as well, all the way to highs of 340, consolidated there for about a month or so, bounced back and forth, and then we obviously saw that sell-off here going on in the past, few weeks here in January, basically. So obviously with Microsoft, they did pretty decent. So Microsoft beats on earnings and revenue, delivers upbeat forecast for fiscal third quarter. So Microsoft did very well as well. If we actually take a look here, some of the big things is obviously the company's gaming business is in the spotlight after Microsoft said it would acquire Call of Duty publisher Activision Blizzard for $69 billion pretty much. So they bought them out, which is huge news right before earnings actually. So as we can take a look here, Microsoft earnings $2.48 per share adjusted versus $2.31 per share as expected. So they beat on that point, and they beat on revenue as well, $51.73 billion versus the $50.88 billion as expected. So revenue increased by 20% from a year earlier, according to a statement, compared with almost 22% growth in the previous quarter. Microsoft's net income swelled by 21% to $18.77 billion. The company had $36.77 billion in unearned revenue at the end of the year, below the street account a consensus of $36.9 billion. So Microsoft said it expects to recognize 45% of its $152 billion in remaining performance obligations over the next year, the first time that percentage has slipped below 50% since at least 2017. So they've had some great things going on here as well. With Microsoft, they have a forward EPS of 9.38, forward PE of about 32.86. We obviously have a dividend with this one as well, about 0.8%, so almost a 1% dividend at $2.48. And then we have a $2.25 trillion market cap. So another huge stock, obviously, guys. Pretty much same as Apple. So whatever Apple and Microsoft are doing is what the market's going to be doing. So if the big companies, we have the big 5 up there, guys. There's at least 5 of them that are doing very well. And whatever they do, pretty much the market is going to do the same thing. They're guiding the market. So Microsoft, Apple, and many of these other companies are saving the market right now, potentially with their great earnings. So can this continue? Will it continue next week? In my opinion, I believe so. I think that Microsoft can continue to grow and will continue to grow in the years to come. And this was a great dip buying opportunity at these levels under $300 at one point. And if we continue to see a little bit more of a pullback in the market before we start to push on higher, potentially at the end of spring, this could be a great opportunity to buy the dip on Microsoft as well. So guys, let me know in the comments below, what do you guys think about these 3 stocks right here that we're going to be talking about? Let me know if you own any of them, if you're buying any of them or holding, or potentially dollar cost averaging on any of them. As always, if you enjoyed this type of content, guys, smash that like button for me. Let's aim for those 40 to 50 plus likes on this video. Subscribe to the channel, turn on that bell notification so you get notified every time I make a new video. And as always, guys, I am not a financial advisor, so none of this is going to be financial advice. This is all for entertainment purposes only. So before investing, speak to your financial advisor and do your own due diligence. I hope you guys enjoyed and hope to see you guys in the next one. Goodbye.